Good morning from our global headquarters in New York. I'm Danny Berger. Manish Cranny is on assignment today. Welcome to Bloomberg Brief. Let's set your agenda. The last piece of data, retail sales are due for a market pricing in near even odds of a half-point cut. A chips redemption, Intel scores a deal with Amazon to make custom AI semiconductors. And Microsoft boosts its dividend, unveiling a fresh $60 billion buyback program. Well, the debate continues. I think a lot of us will be happy when Wednesday's decision is over, done and dusted, and we can decide whether it's 25 or 50. For now, this market is pricing in just over 50% odds that we do get a 50 basis point cut. So you see a 2-year that this morning basically is unchanged. Continued to decline yesterday at a new 2-year low. We're at 3.54% on your 2-year yield. The 10-year yield, that moved lower again yesterday, too. That is trading at about its lowest since 2023, around summer of 2023. We're going to get retail sales data today. Will it be the most important retail sales data that we've ever seen before? Will this tip the scales one way or another? Paul Donovan at UBS says it shouldn't. That one data point shouldn't matter if this is a well-rounded and well-informed Fed. Nonetheless, that comes at 8:30 a.m. The expectation for retail sales is a decline of 0.2% month over month. S&P 500 futures, those had higher this morning, up 0.2%. You've seen this rotation happen underneath the surface, where small caps have been doing better. This morning, though, small caps are still up, but tech is doing better. Microsoft, a story there, and Intel. Will cover that throughout the show. Meanwhile, dollar versus the yen, little change this morning, just above 140. Well, Laura Cooper, global investment strategist at Nuveen, weighs in on tomorrow's Fed decision, writing, while recent chatter raises the risk of a 50 basis point move, we still expect a dovish 25 basis point cut, with Chair Powell to emphasize the need to stay nimble to the evolution of incoming data. I'm pleased to say that Laura joins us now. Laura, first let me congratulate you on the move to Nuveen. Really wonderful to talk to you in the new role. Okay, so here's the debate, 25 versus 50. I don't know if you, like me, are going to be looking forward to when this is over, but just lay out the case for 25.
Well, I think certainly there is an argument to be made for the 50 basis points in the recent days. I mean, if we think about what's coming through from Fed chatter around kind of the media narrative, and what's surprising is that markets are actually pricing in that 43 to 44 basis point potential cut tomorrow or Wednesday. But I think ultimately, if we kind of take a step back, this is not a time for the Fed to really potentially spook markets. There's a risk that markets could extrapolate that 50 basis point move at further meetings, further loosening financial conditions when financial conditions are already quite easy. And then if we think about Governor Waller's comments more recently, he did suggest that they're going to take potentially a more measured approach unless we see a significant deterioration in the data. And so far, employment still remains robust. Inflation, core inflation, is still elevated. There's not that sign necessarily that the Fed has to have that kind of bazooka 50 basis point cut first out of the gate.
I'm glad you point out the Fed speak, because what we had heard maybe say from Powell is different from what the market is pricing. Laura, you talk about not wanting to surprise the market, but there's almost an element of no matter what they do, at this point, they're going to surprise the market because it is at a knife's edge. So just in terms of risk assets, what is worse, a hawkish surprise or a dovish surprise?
Well, I think the fact that we have seen equity markets already rally, you mentioned this broadening in small caps, that's really largely been predicated on the fact that the Fed could make that outsized 50 basis point move. So I would expect some near-term reversal of some of that risk sentiment. And I think crucially what matters is the fact that we think about if the Fed has to cut by 50 basis points, okay, yes, it was an abnormal hiking cycle, so perhaps there is this need to go back into kind of more of that neutral territory sooner. But if they have to cut by 50 basis points, do they know something about the economic outlook that perhaps markets are missing? So I suspect there's greater risk of the Fed doing 50 than a 25. If we have a dovish 25, yes, we're going to see some of that near-term reaction. But then focus will really shift towards, okay, what are they expecting for 2025? We know, looking at the dot plots, that's going to have to be revised potentially quite materially. And even then, looking out the forecast horizon, with markets pricing in more than like 250 basis points of cumulative cuts, that's well above what the Fed currently is messaging. So I think there's a lot to chew on in the Fed meeting coming out on Wednesday.
Yeah. That is maybe even an understatement, Laura. Andrew Lapthorne from SocGen gets at something that you're kind of mentioning there, this idea of a contradictory message, of 200 cuts priced in, of an expectation, a little bit more so now that they start at 50, and yet an equity market that continues to trend higher. Is it a contradiction to have an equity market that is little pricing in anything other than a soft landing, and a bond market which expects an aggressive rate cutting cycle?
Well, this has really been a divergent story for quite some time, the fact that the bond market is pricing in that hard landing, whereas if we look at what's happening in equity markets, it's really priced for this so-called immaculate inflationary backdrop. And I think one of those eventually will have to give. I mean, the way we're viewing it, we still do like equities. It's about being very selective, taking defensive approaches, really kind of staying away from those consumer cyclicals that could be exposed to a deterioration in the economic backdrop. And then on the bond market, there are ample opportunities given we still have this environment of elevated real yields. And so in our environment, we're really looking at playing kind of the short end, the belly of the curve in the U.S. Treasuries quite tactically, and then maybe taking a bit of an up in quality approach in some of those higher yielding credit opportunities. So this is, despite kind of the different narratives, there's ample opportunities for investors.
Just describe that short end call, Laura, because as you say, it seems like the bond market has gone a little bit too far if it is going to be 25 and not 50. So what are you doing exactly?
Well, I think the front end is probably going to be a bit more anchored. Like, yes, we have the 2-year yield trading around that kind of 2-year low. There is scope for some of that near-term aggressive pricing from the Fed to be priced out if they do go 25 basis points. But I think markets will be reluctant to price out the potential for 50 basis point cuts further out. We've heard from Fed commentary, it's really going to be dependent on the evolution of economic data. We are seeing that softness come through. So perhaps we do have volatility in the front end, but not a material kind of retracing of the rally. Instead, I would suspect that we're going to continue to see that curve steepening come through in the U.S.
Yeah, Bank of America just out with their investor survey saying that curve steepening is one of the most consensus trades right now, which maybe is welcome news for people, Laura, because so many people thought it would happen to start the year, and it didn't, and now here we are. One of the other things that has been somewhat washed out of the market is a yen carry trade. The BIS had a really interesting quarterly paper out today, Laura, saying that it's not over. They did some fancy econometrics that are above my pay grade, but basically came to the conclusion that it's not all washed out yet. In a week where we have both a Fed decision and a BOA decision, how much is that on your mind?
I think the Bank of Japan is certainly going to be on the radar once we have that clarity from the Fed on Wednesday. And I think it's going to be a fine balancing act for the Bank of Japan. On the one hand, we want to know their assessment of the current inflationary backdrop. After recent upside surprises, we do have strong wage growth coming through, which does suggest this inflation trend is becoming more entrenched. But yet, we've known from the lessons from the last couple of meetings, they're going to want to assess market jitters. They don't necessarily want to spook markets the way they had previously. Now, when it comes specifically to the yen, we've seen this material appreciation, and I think that probably has run its course. Yes, there's maybe a little bit more scope to the strength side, but if we think about, the Japanese yen doesn't necessarily have to rally on a USD rate cut, and I think that's largely because if we think about, growth dynamics matter, U.S. growth, so long as that continues to persist, we're unlikely to see that repatriation back into Japan. And as well, a lot of that outflow from Japan that we've seen has been from sticky, life insurers. So they're going to be less vulnerable to some of those near-term moves. So at this point, I think the yen against the dollar is probably going to trade a little bit more sideways. Key risk, though, is if we see the U.S. recession materialize, then we could see some of those aggressive Fed cuts come through, at which point USD yen could trade closer to that 130 mark. It's not our base case, but certainly there are going to be corners of risk in these markets that not only policymakers but investors have to be quite acute to.
Laura, I really look forward to catching up again after this week when we finally have some answers. Laura Cooper of Nuveen, thanks for joining this morning. Okay, let's get to some other top stories that are trending on the terminal. Amazon is going through a shakeup. CEO Andy Jassy is streamlining the company by cutting management layers and ordering employees to return to 5 days a week in the office. In a memo to employees, Jassy said that he wants Amazon to operate like the world's largest startup. Chinese automaker BYD is taking full control of joint venture that it had in China with Mercedes. The deal was announced without a value in a statement late on Monday. The move comes as more foreign automakers dial back their exposure to the world's biggest auto market. And the European Commission president proposed a sweeping financial and industrial portfolio for France in her next commission after a dramatic late-minute switch in nominees. As well as France, Italy, and Spain won key roles for the bloc. The EU is under pressure to respond to growing industrial challenges from the U.S. as it digests the Draghi report outlining them. Coming up, Intel surges pre-market, news of a deal to make AI chips for Amazon. Well, the details on that 7% rally. And Kevin Mahn of Hennion and Walsh Asset Management bets on a gradual approach to easing from the Fed, much like Laura Cooper. We continue the debate later this hour. It's Bloomberg Brief. It's your Bloomberg Brief. I'm Danny Berger in New York. It's a win for Intel, a rare win these days. The chip maker has landed Amazon's AWS as a customer to co-invest in a custom semiconductor for AI computing in a multi-year, multi-billion-dollar framework. All of that coming from a statement released yesterday. CEO Pat Gelsinger is saying this in an interview. This announcement is big. This is a very discerning customer who has very sophisticated design capabilities. For more, let's cross over to Bloomberg Daybreak Europe anchor Tom McKenzie, who's been tracking this. Tom, I mean, it's been a tough stretch for Intel. Their shares are down something like 60% year to date.
Yeah.
Does this represent confidence and maybe something turning around for them?
Well, look, it's undoubtedly, Danny, to your point, a vote of confidence in Intel and its ability, the company's ability to design, not only design, but also manufacture and produce AI chips, of course, where they have struggled, notably, hence the downturn in the stock. The competitive threat, of course, of NVIDIA, of course, taking the front foot on this. It shows that at least AWS thinks they have the competency at Intel to partner with them, co-invest, again, for a multi-year and, as you said, multi-billion-dollar project or framework. So yes, it's a vote of confidence. It comes after this crucial board meeting, of course, at Intel's HQ last week. More details as well coming through on the back of that. They're going to be suspending the factory build out, importantly for Europe, in Germany and Poland. They have also announced they managed to secure about $3 billion, potentially up to $3 billion in financing from the US government to build out chips for military uses. So that's another tick in the box as well. The factory and foundry build out in the US continues across those different states. And of course, all of this coming on the back of announcements around a 15,000 job cut across the business going forward to try and save around $10 billion US. But the deal and the cooperation partnership with AWS is absolutely a vote of confidence. And Pat Gelsinger rightly touting it. And of course, he'll hope that other big corporate players and corporate clients get on board as well.
Speaking of a vote of confidence, Microsoft certainly gave themselves one, returning a lot of capital to shareholders. What are the details of it?
So $60 billion in terms of the buyback, so matching a previous record, upping the dividend by 10% as well to 83 cents versus 75 cents in terms of the dividend. So big buyback, dividend increased, and it's a reminder that this is a company that sits on a lot of cash. By the last account, the numbers that came through in June, they were sitting on cash and equivalents of about 75 billion US dollars, because this company, unlike up until this point Intel, Microsoft has actually really benefited, of course, with its partnership with OpenAI in getting that front foot around generative AI, and they are starting to see that monetized on products like Copilot. They have that balance sheet, they're returning some of that now to their investors, and they look like they're going to be rewarded for that at the opening with the pricing that we're seeing right now.
Just to wrap this up, Tom, geopolitics are never far from a chip story. The FT has a story this morning that the U.S. and Japan are nearing a deal to curb chip tech exports to China. I feel like I've asked you about some version of the story, maybe every other week over the past year. What is the latest?
Yeah, so it's evolving, and as you've said, this is reporting from the Financial Times, specifically Japan and the US are getting closer to agreeing coordinated action in terms of restrictions of technology, the hardware, the software, into the Chinese market. There's a countdown now to the election in November. The reporting from the Financial Times saying the US wants to get a deal with the Netherlands and Japan to ensure that they can collaborate before additional measures are put in place by the US. So essentially that you can carve out Japan and the Netherlands from that because they've already agreed to restrictions. The background is US companies cannot send their employees onto the ground in China to service the equipment. Japan, the likes of Tokyo, Electron, ASML in the Netherlands still can. The US wants to stop that, and they want to make sure that their allies are on board before they push through additional restrictions ahead of the US elections in November.
Tom, we appreciate it as always. Tom McKenzie there, who you can catch at 6 a.m. UK time on Daybreak Europe. Okay, coming up, resetting the narrative, how the former president plans to turn his second assassination attempt into political momentum. This is Bloomberg.
The Secret Service for the expert handling of the situation, and the former president is protected from harm and the subject is in custody. Let me just say, there is no, and I mean this from the bottom of my heart, those of you who know me, many of you do, no place in political violence for political violence in America. None. Zero. Never.
That was President Biden speaking on the assassination attempt on former President Trump. Now, at the same time, you have Trump trying to portray a message saying that it is the Democratic rhetoric which has put my life at risk. As far as the Democrats go, the language has been meetings with Teamsters, Harris meeting with them, an endorsement still dangling, maybe some frustration there that they haven't yet endorsed them. Okay, let's take a pause on the politics for just a moment. At 5:20 in the morning, we are waiting for retail sales. That comes at 8:30 a.m. Eastern. Is this going to be the most important retail sales data that we have yet to see? S&P 500 futures up 0.33%. The dollar little changed. Your 10-year little change this morning. We are awaiting. Now, politics has not been changing this market. Let us be clear, even though it vastly did after the first assassination attempt on the former president's life. So now the Republican nominee is trying to gain back some of that momentum that he's lost since Vice President Harris became the Democratic nominee. Joining us now is Bloomberg's Derek Wallbank. Derek, Trump has been using this language saying it is them, it is the rhetoric that has put my life in danger, trying to do a shift like we saw earlier in months prior that saw the end of President Biden's presidential campaign. How should we judge the success of Trump trying to change the momentum this time?
Well, I think first off, Danny, it's going to be a little bit tricky because some of the rhetoric that Donald Trump is accusing or faulting the other side for, he and his vice presidential candidate have either used very similar words, very similar phrases, or in the case of Vance and Trump particularly, they're facing their own sort of questions about rhetoric that they're using to describe situations ongoing with migrants in Ohio, right? The dogs and cats and all of that scenario. It doesn't bear witness to go into all of that too much at this moment. The key point is, though, it's not necessarily landing as much this time as the last time. There is a fear, there is a real fear, I do think, that there may become a normalcy or a desensitization to some of the things that we're talking about. Now, to be clear, the idea of someone showing up at the golf course that the former president is playing on with high-powered firearms and all of that, that's a very scary situation. You know, we are less than 2 months out before Election Day, and it's a very tight race. And, you know, as President Biden said, there's no place for that in American society. Yeah. But here we are in this unprecedented election year, and we're starting to see this now again.
Derek, we're going to have to end it there. Thank you so much for joining this morning. That is Bloomberg's Derek Wallbank. Now, the race for the White House is also being closely watched around the world, including the Middle East, where tensions remain high. Bloomberg's Jomana Bercecci spoke exclusively with the Iraqi Prime Minister. Take a listen.
فهمنا Our understanding of the situation of the relationship between Iraq and Iran is based on mutual interests and mutual respect. Iran is a neighboring country, and we share 1,400 kilometers, and it's in our interest to have a close relationship, especially that Iran has been supportive of the political process and our efforts in combating terrorism. Of course, Iraq is the only country in the region that has a special relationship between Iran and the United States, and we try through this positive characteristic to help in bringing opinions closer, and we are interested to have stability in the region, away from the Axis policy. We don't want the tense relationships and the stances of other countries of the world to impact the Iraqi situation. This is our diplomatic effort and movement in terms of our bilateral and regional ties.
That was the Iraqi Prime Minister speaking to Bloomberg's Jomana Bersetchi in an exclusive interview. More on the Fed to come. It's your brief. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Manish Cranny is on assignment. Let's set your agenda. A test for the 50 camp. Markets await the latest retail sales data that could pull back bets on a half-point Fed cut. A chip redemption. Intel scores a deal with Amazon to make custom AI semiconductors. And Microsoft boosts its dividend, unveiling a fresh $60 billion buyback program. Well, plenty to cheer about for tech this morning, but it really has been the small caps, this rotation that's been happening over bets of a 50 basis point cut. We are about even odds this morning about whether we go 50 or 25, but the speculation of 50 over reports and different outlets, over Bill Dudley's recent Bloomberg opinion column, has meant that two-year yields are trading at their lowest in 2 years. Little change this morning, again, waiting for that retail sales data. S&P 500 up 1/3%. Yesterday, again, it was all about small caps and the rest of the market joining in. Even though tech had a worse day, that means an equal weighted measure of the S&P 500 hit a new all-time high yesterday. Meanwhile, sort of in the theme of just waiting, seeing what's going to happen today, Japanese yen, little change, just at 140. So it's the last piece of data. With a data-dependent Fed, retail sales comes out at 8:30 a.m. Joining us on what to expect is Bloomberg's Jill Desis. Jill, what are we expecting today?
Yeah, well, Danny, I don't think I've ever seen this much attention paid to a set of retail sales data ahead of the Fed meeting, but I think just really telling you there, how much that coin flip bet on 25 versus 50 basis points is really feeding into some of these things. So, look, what we're really expecting out of this data set is probably a fall of about 0.1% for that overall number, likely dragged down a bit by car sales. That would be a bit of a reversal from what we saw, a sharp uptick in July, but the Fed is probably just going to see this as, kind of a trend back toward a bit of moderation. If you exclude, auto sales, other things from the control group, which will exclude also like, more volatile costs like building materials and food, probably seeing a little bit of a better, more steady, growth there. But ultimately, Danny, I think it really just kind of, shows us that, yes, the Fed is probably going to pick apart just as markets are at every single tiny little piece of data that they can get heading into this decision on Wednesday.
But it's the whole thing of being data dependent, but not data point dependent. I mean, this is one data point, Jill. Does it really have the ability to push the Fed in a direction or end speculation of one cut versus the other?
I don't know, Danny. I feel like, barring anything other than like a really surprisingly strong set of data. I mean, if you just have something that really, really surprises to the upside, and then maybe you're reinforcing the view of some of those inflation hawks like Michelle Bowman, maybe that tips the Fed more toward considering more definitively 25 basis points versus 50 basis points cuts. When it comes around to the Fed decision, it's really difficult to see this moving the needle all that much. I really think at this point, it just symbolizes that the market here, is really sort of craving some more certainty here. I was reading some research that we had put out earlier. I think at this point, right now, we're looking at the greatest amount of doubt in interest rate swap markets for any scheduled U.S. central bank decision since 2007, barring that emergency rate cut in 2020. So, I mean, really, again, just showing you how much, the markets are clamoring for more certainty here. It's kind of unusual that we'd actually head into a Fed decision with this much uncertainty over that 50 versus 25 basis point line. Again, does, one set of, month of retail sales data give us more, definitive proof? I think that you'd have to be looking for a shocker there to give you a full answer.
And probably worth mentioning that in 2007, the credit market had just collapsed, and here we are. Spreads are tight. Everything looks great, and still, we don't know what's going to happen. Bloomberg's Jill Desis, thanks so much. Joining us now to get further into the debates, Kevin Mahn, President and CIO at Hennion and Walsh Asset Management. I mean, Kevin, can we just take a step back?
Sure.
What does it say about this moment that we are debating whether retail sales can move the Fed? We're digging through the tea leaves of FT and Wall Street Journal stories about whether it means something, and we just don't know what it's going to happen. What does it mean about this environment that we're in?
All the benefits of Fed transparency, right? It actually has created more uncertainty and more volatility in the markets. I think the Fed is set. Tomorrow will mark the beginning of a gradual easing campaign that will likely last all the way through 2026. Will it be 25 basis points? Will it be 50 basis points? We don't know. We don't have a vote on the FOMC. I believe it's going to be 25 personally. In fact, I think they revert back to their dot plot chart that they had in March and coming into 2024, which showed 325 basis points cuts this year, 325 basis points cuts next year, and another 325 basis points in cuts in 2026, bringing them closer to that rate of 3%. And I think that's going to be the normalized rate where they want to get to. The pace that they get there, we'll have to wait and see. But I think they go 25 basis points tomorrow.
Can I just settle the debate in terms of this? 25 or 50, if you're an asset allocator, doesn't matter.
It really doesn't. Look where we stand right now. Short-term interest rates are at a 22-year high. Even if they do cut rates 3 times by 25 basis points each, we'll still be at a 17-year high. So rates won't be as high, but they will be high from a historical perspective. I really need to see them get about 1 to 1.5% lower to have any meaningful impact on the economy. But it does start to free up other areas of the markets that haven't really participated in the rally so far, like small caps. How about a defensive area that we've seen rallying thus far this year, like utilities having its best year in a decade, mostly because of their tie into the AI revolution?
The utilities thing I find so interesting, and Bank of America's investor survey just came out saying that investors are the most long utilities since 2008. You have some really fantastic stats on just how well they've done. Okay, it's defensive, it's AI, it's everything to everybody. At what point do you say this rally has gone too far, or is there enough in this trade to just keep juicing it along for longer?
There's definitely enough in the trade, right? You think of a backdoor play into the AI revolution. All these data centers run hot. They consume massive amounts of electricity, but they can't generate their own electricity. They have to turn to the utilities of the states that they operate within. So look for those utility companies that pay an attractive dividend, that are trading at a reasonable valuation. Right now, the PE in the S&P 500 is around 24. We found 2 names that have a PE below 24. It's names like Sempra Energy, or how about NiSource? And even another like Southern Company, trading a little bit above that PE, but paying a nice 3% dividend yield. These companies provide electricity and natural gas to individuals, to corporations, and to data centers, Danny.
If we, though, get in an environment where, let's say, NVIDIA has a weaker earnings, or some of these hyperscalers, Meta, Google, what have you, say, we're not sure we're going to get that return on our investment, so we're pulling back slightly. How much does that affect utilities? Does this become a whole new risk for them?
It does become a potential risk, but let's just consider this. It's estimated by the end of 2030 that data centers alone will consume up to 10% of our country's electricity grid. We need to solve for that. We need to expand our infrastructure, which creates additional investment opportunities. But I still believe that utilities, even absent the AI revolution, are a nice home for defensive plays. They provide a nice income stream. And they also, when interest rates are lower, provide income capabilities. All of these 3 utilities I just spoke about have a dividend yield of roughly 3%. If we get back down to that normalized rate of around 3%, all of a sudden those utilities look pretty attractive again.
Speaking of dividends, Microsoft upping theirs, a chunky buyback. I mean, yield, all things considered, still relatively low for Microsoft, but you'd expect that for a tech player. With their continued devotion to buybacks, to increasing their dividend, how attractive is Microsoft right now?
As a portfolio manager, it's hard not to like buybacks and dividend increases. And certainly Microsoft was very early to the AI game with their strategic investment in ChatGPT. What they're doing right now with 360, their continued investment into AI. We have to remember, Danny, that AI is a long game. A lot of these investments that are taking place right now, the CapEx spends that are taking place right now, won't pay dividends, pun intended, for quarters, if not years to come. So we need to be patient. But look for those companies that have the balance sheet and also the expertise to stay within the AI game. Microsoft certainly does.
And that's also behind, just from an overall market perspective, of what's enforcing this earnings growth. I was just looking at the forecast this morning, 14% expected in 2025, 10% the following year. Those are still pretty punchy figures. And then going around to where we started, when the trajectory of this economy and how the Fed cuts is unknown. Are we a little bit too optimistic? Again, maybe save for tech, maybe save for AI, that profits can be turned out to those degrees?
It really does depend on the Fed and the pace of their easing. If I think about the retail sales number, that's going to come out around 8:30 Eastern. If that number disappoints significantly to the downside, that just reinforces that the consumer is in trouble, right? The consumer is pulling back on their reins of spending, and the consumer accounts for 70% of our economic growth in the country. The Fed can help with that potential issue by cutting interest rates. I don't think 50 basis points, but if over the course of the next 2 years they're 2.25% lower, at least on the short end of the curve, that will certainly help.
Well, with consumer companies dealing with that environment, you've seen this really big split. And it's not even just the bifurcation of luxury versus not. It's just who's coping with it well. I don't know if you saw the Amazon bot. Yesterday it was everywhere. It was basically peeling avocados on its own. Everyone was.
I love avocados.
It was called the Autocado, in case you were curious.
Clever.
But so you have these companies trying to cope with, margins coming under pressure, more automation. McDonald's, they're putting in now, you can put cash into their screen so you don't need to deal with the cashier. When you're looking at companies exposed to the consumer, are you seeing things that are attractive? Are you seeing companies that can withstand an environment, even if we get sales data in today that does look particularly weak?
Yeah, let's say for argument's sake, and I'm not saying we're going to have a hard landing, but clearly that's a concern to the Federal Reserve. Why else would they be considering cutting short-term interest rates by 225 basis points over the next few years prior to getting their inflation target back to 2%? Because the over-leveraged states of the U.S. consumer and the federal government, for that matter. How about some consumer staples names? They've been having a pretty good year so far. Even in the event that we do experience a hard landing, people still need to brush their teeth, wash their hair, buy diapers, hopefully. And those types of companies can weather those types of economic slowdowns and periods of market volatility. So consumer staples, healthcare, utilities, good defensive plays, find those companies with strong balance sheets that pay good dividends, and they should be able to provide a nice,
I'm liking this, a barbell, the defensives, and the AI. Kevin,
perfect.
It's so wonderful to have you on. Thank you so much for joining in person this morning. That is Kevin Mahn of Hennion and Walsh Asset Management. Okay, coming up, speaking of tech, Intel, it is surging pre-market. A news of a rare win for the company. We're going to give you the details next, with those shares higher by more than 7% pre-market. It's your Bloomberg Brief on this Tuesday morning. I'm Danny Berger in New York. A much-needed sigh of relief for Intel CEO Pat Gelsinger as the chipmaker lands Amazon as a customer. Intel and AWS will co-invest in a custom semiconductor for AI computing in what they're calling a multi-year, multi-billion-dollar framework. That's according to a statement that they released on Monday. Now, they're trying to navigate through shrinking sales and mounting losses. For more, let's get over to Bloomberg Intelligence senior tech analyst Mandeep Singh. I mean, Mandeep, this comes off the back of Intel postponing new factories in Germany and Poland, trying to right-size their workforce. Is Intel even ready for a project such as this to team up with AWS and get them what they need?
Well, look at it this way. Right now, the hyperscalers are the ones who are spending the most on chips. The overall budget for hyperscalers on just AI chips is north of $100 billion, which is why you see that kind of growth in NVIDIA. So in the case of Intel, they just want some orders from these hyperscalers. And I think it's a good start that they have landed Amazon as a customer. Look, Amazon will still have its leading edge chips made at TSMC, but the fact that they are ready to use Intel Foundry in some capacity, some custom chip, I think it's definitely a good sign.
So what more does Intel need to do then to start building confidence? Where are they in this journey?
I mean, they just have to offer proof points that they are catching up when it comes to process nodes. It's not going to happen overnight. That's why it's taken this long. And, landing more hyperscale customers like Amazon would definitely be incrementally positive. And they're doing the right thing by narrowing the scope of their foundry business. So they're not building new plants outside the US. And we know things could go wrong when it comes to geopolitical tensions that we are seeing out there. Maybe customers may want to diversify their manufacturing, and that's where I think Intel Foundry still has a chance when it comes to, the diversification play that is there on offer.
Mandeep, elsewhere there was this story that Amazon is trying to also reestablish or reorganize itself, basically cutting out layers of management, trying to streamline things. What does this say about Amazon's growth trajectory and just how bloated the organization has become?
I mean, every company right now is trying to right size, and they probably overhired during the pandemic as well. And what we have seen, the trend is very clear, lean organizations trying to do more in terms of AI. And the way you get those investments is you have to restructure stuff somewhere. So the fact that they're raising their CapEx, the fact that they're investing big in AI, they have to cut somewhere. And that's what every large company seems to be doing at this point of time.
And then you have, though, on the other side of Microsoft saying, look at all this cash we have. We're going to give out more dividends. We're going to boost our dividends, rather, $60 billion of a buyback. They also announced a new set of tools yesterday, too. Is this Microsoft laying down the gauntlet, saying, look at how invested we are in ourselves and how confident we are with our future?
Absolutely. And look, one of the concerns that investors may have with Microsoft is they are overinvesting when it comes to AI CapEx. And what they are saying is it's not going to have any impact on our dividend return, our buyback plan, and we can still continue to invest. And that's a sign of confidence. They believe that the AI wave will help them generate more free cash flow in the long run. And I think that's what they're signaling here.
Hey, Mandeep, we really appreciate it. That is Bloomberg's Mandeep Singh. Now, another firm revamping its business, BlackRock, the world's largest asset manager, is shaking up its private credit business in an effort to catch up with competitors. Bloomberg's private credit reporter, Silas Brown, joins us now. Silas, I mean, it's BlackRock trying to be everything to everyone. So what does a private credit push look like at the company?
Yeah, so look, what they're doing is they're kind of building a new division within BlackRock called the Global Direct Lending Division. It's going to be led by Stéphane Caron, who was, up until recently, the European mid-market private debt head, and actually formerly an Olympic swimmer as well, a medal-winning Olympic swimmer. But I think what they're trying to do is trying to make a kind of big push into what's clearly a key growth driver for the firm, and I think broadly private markets as well. Credit is on the rise, and so I think what they're trying to do is kind of streamline and effectively push further into this market.
I love that he was an Olympic swimmer. That is such a good detail. I mean, what is it with these like asset managers and financial firms just hiring athletes? Us normal people stand no chance.
He's actually a two-time Olympic medal winner.
Important clarification, Silas. Okay, so I mean, you mentioned, look, they're trying to make this push, but it's not like this is something new. It's not like the explosion of private credit is just happening. We were calling it the golden era, last year, the year before. So why now? What prompted this move to set up this unit?
Yeah, I think if I was to be a contrarian, I would say that BlackRock, given its scale, should arguably be larger and a larger presence in private markets, and particularly within private credit. I think they manage about 35 billion of direct lending assets at the moment. That is, substantially smaller than the market leaders like Ares and Blackstone and Apollo. So I think, but clearly, what we're seeing as well from BlackRock is a kind of concerted push into private markets. They've been on a bit of an acquisition spree, made a lot of headlines buying GIP for $12.5 billion. They've also bought one of the leading data providers in private markets in Preqin. So I think there's a recognition within BlackRock of trying to be more of a dominant presence within the industry.
Just where do we stand on the industry and the opportunity set within private credit?
So I think within private credit, I think the asset class is clearly expanding. Some people expect it to double to 3.5 trillion by 2028. So clearly there is a big opportunity to be had, but at the same time, I think that opportunity is increasingly being shared by a smaller amount of leading practitioners. And so I think the growth in the industry is being focused on the likes of Blackstone and the likes of Ares. And I think BlackRock is understanding that and also trying to be within the kind of market-leading bracket that will be the firms that will be truly enjoying the benefits of the growth of the industry.
Hey, Silas, just fantastic. Thank you so much for joining us. Silas Brown there, our own Bloomberg, Olympian in spirit, Silas Brown. Okay, some breaking news just crossing the terminal. This is fascinating. The PGA Tour and the Saudis are still working on the financial details of their joint venture of the LIV tournament and the PGA Tour coming together. I just want to read you what our reporting is because it's about pay. The particular sticking point is John Ram's reported $300 million LIV contract that was struck late last year. According to people familiar, some PGA Tour players want Rahm and others to hand back the money that they've made. Other options include paying fines to participate in events, giving to charity, or agreeing to forfeit any future career winnings on the PGA Tour. Rahm and the other LIV golfers have refused on any terms that would penalize them. So that is the sticking point. They want them to return the pay. Okay, that's the latest on golf for you. Coming up, we're going to set up the week and your retail sales data on your Bloomberg Brief. It's Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up for your trading on this Tuesday morning. Numbers for retail sales for August, those will come out at 8:30 a.m. Eastern, maybe the most important retail sales data in recent memory. Jamie Dimon will then be speaking at Georgetown University. That's at 4:15 p.m. And then on the politics front, former President Trump has a town hall in Flint, Michigan at 7 p.m. Now, in terms of stocks on the move pre-market this morning, Dell extending some gains. It got a new outperform at Mizuho. The price target is 135. You can see it's trading well below that at 117. Their call is all about AI. Meanwhile, Keurig, Dr. Pepper, that also higher in the pre-market trade just by 1%. It raised its quarterly cash dividend by 7%. Again, Microsoft did something similar. Those shares are up about 2%. So we are just a few hours away, about 2.5 hours away from the retail sales data coming in. Will it move the Fed? Perhaps not, but maybe it will move these markets. Not much activity, save maybe for this equity market. We're moving higher this morning. Outperformance from tech, both because of what Intel is doing, that deal with AWS, and the Microsoft dividend and buyback. Russell 2000 also outperforming. Your bond market is little changed. The yen, little change. Again, waiting for the retail sales data.